On Wall Street, there's an old proverb that goes, if you don't sell it, you haven't lost it. Put another way, don't worry about the ups and downs in between. The value of your investments doesn't really matter until the day you need to cash out. That's not very consoling when your stock portfolio has crashed and lost 20% or even 30% of its worth. Don't alter your plans unless there's a compelling reason to do so, if you have faith in your investing approach and the assets in your current portfolio. After all, it's possible that you considered a market crash similar to this one when you constructed your portfolio. In times of crisis, panic sellers frequently come to regret their decisions. Consider those who sold high after the S&P 500's sharp decline of almost 30% in the spring of 2020. By summer 2020, when the lightning-fast pandemic rally had erased the early COVID market losses, they were already second-guessing their decision. And by the year's end, at the bottom of the fall, they had lost out on 65% of the gains. Events like the development of COVID-19 or the announcement that the Federal Reserve will be altering its monetary policy plan can lead to market crashes. Even worse, sharp drops in the market might drive aggressive speculators to make forced trades because they borrowed money to purchase stocks and are now facing margin calls, which further reduces the value of their stock holdings and sets off a chain reaction of selling. Here's the thing though, chances arise from a market downturn, particularly for astute investors. You might be able to treat yourself to the stocks and funds you've had your eye on at deep discounts, or you can just keep purchasing shares according to your usual investing plan. The best strategy to go on a buying binge during a volatile market is to dollar cost average your purchases. This entails consistently making purchases with a predetermined dollar amount, even in the face of a shaky market. By balancing the highs and lows of your average purchase price, dollar cost averaging frequently lowers it over time. By spreading out your purchases, you lower your risk because you won't be making a large investment at a single market price. That should help allay your fears about what if the stock market gets crushed tomorrow. When investing through a retirement plan offered by your employer, dollar cost averaging takes place automatically. If you're feeling a little more daring, declining markets can be an excellent opportunity to think about letting dividends guide your investment decisions. Many businesses distribute their profits to their shareholders as an annual, tiny dividend payout, just like banks do with savings account holders. Companies that pay dividends tend to be more established and have less volatile share prices, but dividends aren't always guaranteed and can fluctuate. As long as the dividend is distributed, there are usually profits. This indicates that when a share price and returns would otherwise be declining, investing in dividends might be a good decision during market downturns. Transferring funds between stock market sectors is a tried and true method of managing market downturns. In periods of rapid expansion, for example, tech stocks tend to perform well. Conversely, boring industries like utility stocks will often fare well during recessions. Thus, you might be able to prevent significant declines in a specific industry if you switch between them wisely. However, not everybody agrees with the notion of sector rotation. Investing in diversified index funds can help you avoid this problem and maintain strong returns regardless of the performance of a single sector. According to the so-called Bong King, Jeffrey Gundlach, the best course of action for investors in the higher-for-longer interest rate environment is to T-bill and chill. Gundlach, whose Forbes estimate puts his net worth at $2.2 billion, stated that higher-for-longer interest rates had the potential to spark a significant economic crisis in the U.S. during an interview with CNBC's Closing Bell program on Wednesday. Interest rates were maintained by the Federal Reserve at a 22-year high of 5.5% to 5.25%. The central bank issued a warning in September, stating that higher interest rates would be necessary to control inflation for a longer period of time than anticipated. According to Gundlach, the federal deficit as it stands is completely unsustainable given the current state of interest rates. The deficit reached about $1.7 trillion in fiscal year 2023. By the end of 2023, the U.S. Treasury is anticipated to borrow over $1 trillion through short-dated T-bills as the government attempts to increase its cash reserves due to historically high levels of fiscal spending. The government will pay $640 billion in net interest this year, quadrupling the amount it paid in interest between 2015 and 2023, according to the Cato Institute think tank. By 2051, interest payments are predicted to surpass all other government expenses. Not just Wall Street's biggest names, like Gundlach, have expressed concern about the possible negative economic effects of excessive government expenditure. The wealthy financiers Ray Dalio and Stanley Druckenmiller, as well as Jamie Dimon, the head of JP Morgan, have all raised concerns in recent months regarding the deficit. In 2009, Gundlach co-founded Double Line Capital, which now oversees over $100 billion in assets. The company quickly outperformed competing bond fund managers. He became known as the Bond King or King of Bonds as a result of his success. The housing meltdown of 2007 was also accurately foreseen by the billionaire bond trader. When asked about his approach to investing while the Fed maintained high interest rates, Gundlach responded that, despite the current strong returns on cash, he wasn't a fan of retaining a sizable amount of it. The year 2024 is rapidly approaching, and the question on everyone's mind is, will the US enter a recession? Analysts differ, but Double Line founder Jeffrey Gundlach is one voice that is cutting through the ambiguity with a razor-sharp edge. In a series of astounding interviews with Fox News and Yahoo Finance, Gundlach presents a vision of the economy that is as vividly dire as the worst possible fears. According to him, the cost of interest on U.S. debt is skyrocketing, much like a rocket aiming for the stars. And if you felt your heart skip a beat at that, get ready for Gundlach's audacious claim that the U.S. is effectively in a death spiral with your personal money, and by the second quarter of 2024, we'll definitely be in a recession. Thus, there are established indications that have been useful in the past and strongly point to a worsening of the economy in 2024. However, Gundlach stands out from the rest due to his prediction of a post-recessionary twist. He said that lower economic growth could cause interest rates to fall at first, but they would then rise again like a jack-in-the-box. You should be intrigued because he believes that an inflationary response to an epic fiscal crisis will send interest rates skyrocketing into uncharted territory. However, not all Gundlach skepticism extends to the Magnificent Seven. The undisputed winners of 2023 have been the IT giants who have dominated the stock market with an iron grip. Apple, Amazon, Microsoft, Nvidia, and Tesla. The SAS playbook's tried and true land and extend strategy has been expertly implemented. The company's intense focus on its enterprise clientele has paid off handsomely, as evidenced by the remarkable dollar-based net retention rates of 121%, or an astounding 125% when currency effects are taken into account. In the Q3 UI route becoming the savvy player. By implementing a more segmented sales approach and making significant investments in industry verticalization, it has accepted change. This calculated risk-taking move has allowed the company to grow both within its current clientele and into uncharted territory. A growing number of new clients are reaching out to a wider audience as they realize the enormous potential that automation holds for practically every industry. Collaborations with industry titans such as SAP and T-Systems in Europe are advancing the company, increasing its market presence and speeding up adoption. Partnerships are a game in practicality in every industry. UiPath's dedication to innovation and consumer-centric solutions is demonstrated by their latest collaboration with SAP, which provides a customized solution for SAP clients. Artificial intelligence UiPath combines automation and AI to not just ride the wave, but to shape it. The UI approach increases its total addressable market, or TAM, by removing tedious tasks and reaching for the holy grail of efficiency. This is a calculated move that demonstrates UiPath's vision and readiness to take advantage of emerging prospects. The financial outlook for UiPath is bright, with revenue forecast in the region of $381 to $386 million for the fourth quarter of fiscal 2024. However, the company is not content to sit back and enjoy its current success. That's all for today. If you like this video, please give us a thumbs up. Make sure to subscribe to our channel and hit the bell icon to receive notifications. Also, express your valuable thoughts in the comment section below. Until then, bye. Also, spend some time watching other videos on the channel.